Welcome to this explainer. Today, we're diving into something truly fascinating. We're going to unpack how a ridiculously simple habit, literally just investing 35 bucks a week, can eventually completely surpass the income from your full-time job. I know, it sounds like an absolute pipe dream, right? But it's really just the raw, unyielding tower of consistency. Look, if you've ever felt like your paycheck completely evaporates before the month is over, you are absolutely not alone. Time usually works against our paychecks, but here's the incredible secret we're exploring today. Time works beautifully for your investments. Let's see exactly how this plays out. Okay, so let's start with the elephant in the room, the very real problem we're all feeling every single day, the massive inflation squeeze. Put simply, our world is getting more expensive and it's happening way faster than our paychecks are growing. Think about it. The $20 worth of groceries you picked up back in 2020, yeah, that exact same basket costs over 25 bucks today. And it's not just the grocery aisle. Borrowing money, mortgages, credit cards, the whole shebang has gotten noticeably heavier. You feel this squeeze, right? We all do. And to make matters worse, while your everyday costs are shooting through the roof, your paycheck is kind of just stuck. On average, year-over-year pay growth has been lingering around a meager 3.8%. Let's be real, that barely even scratches the surface of the inflation we've been living through recently. Your paycheck is mathematically losing ground. So what do? Where's the lifeline here? Well, usually we'd look to the stock market, but when you're already feeling the financial pinch, putting your hard-earned cash into the market can seem absolutely terrifying. I mean, we've lived through some historically frightening crashes. The Great Depression, the dot-com burst in 2000, the 2008 financial crisis, the COVID crash, that nasty 2022 inflation decline. In the moment, those drops feel like the literal end of the financial world. But here's the absolute game changer. Historically speaking, every single major market drop has eventually recovered. Every single one. So, despite all the scary headlines and our own natural instinct to just panic at the first red arrow, the market actually trends upward over the long haul. In fact, research consistently shows that long-term historical market returns sit right around 10 to 11% per year, and that includes dividends. This is exactly how you beat that inflation squeeze. While your job might only hand you a 3 or 4% raise, a solid long-term portfolio is out there growing 2 to 3 times faster. It's actually fascinating to watch this play out using what's called the snowball effect, and we can see it with a tiny amount, just 20 bucks a week. In year one, you put in about $1,000, right? $1,040 to be exact, and the needle barely moves. But stick with it. By year three, you've chipped in $3,120, but your balance is sitting around $3,750. That extra cash is the snowball starting to pack together. Fast forward to year five, you've contributed $5,200, but your account is up near $6,850. Those early deposits, plus the dividends being reinvested, are quietly doing the heavy lifting behind the scenes. It's not explosive at first, but it is laying down absolutely vital groundwork. And that brings us to a massive mindset shift you have to make. Most of us really struggle with weekly investing because, frankly, the early results are just too small to get excited about. We want instant gratification. But you have to tune out the short-term noise. Stop expecting linear, straight-up progress. Instead of tossing and turning over every little market dip, just ask yourself one simple question. Did I invest this week? That routine, that habit, that's the only thing you actually control. The source material points out that once you've got that rock-solid mindset locked in, you need to pick investments that hit a few absolutely crucial targets. You want diversification, so if one company completely tanks, you don't go down with it. You need broad exposure across different sectors and company sizes. You definitely want a proven track record of historical performance, companies that have a history of actually growing their dividends year after year, and, this is a big one, low fees. You want to keep your own money, right? When you combine all these criteria, you build a fortress of a portfolio that captures growth but can still take a punch during a downturn. Now, let's look at an actual solution to build this perfect engine. The research highlights a brilliant combination of 5 specific Fidelity funds. You've got F0X as your zero-fee core, grabbing the entire US market. Then FSMDX jumps in to capture the rapid expansion of mid-sized companies. FITLX gives you a modern edge by targeting sustainable, forward-thinking companies. FGRIX steps up to perfectly balance steady growth with really reliable dividend income. And finally, FDGFX acts as your anchor, focusing on absolute safety and consistency. And wow, just look at those dividend growth rates. Some of these are pushing almost 20%. But we're not going to overcomplicate this. Nobody wants to spend their weekend trying to guess which sector is going to outperform the others. So we're going to treat each of these 5 funds as an equal 20% slice of our portfolio pie. Nice and easy, you get the wide coverage you need without the headache. It keeps everything perfectly balanced, super simple, and incredibly resilient to sudden market shocks. And the math behind this strategy? It's surprisingly straightforward. You might be wondering, so what does this whole mix actually pay me? Well, if you add up the yields of all 5 funds, you get a total of 10.93%. Since we're weighting them all equally, you just divide that number by 5. Bam! You've got a straightforward average overall portfolio yield of 2.19%. Easy peasy. Following that exact same really simple math across the board, we uncover some seriously powerful portfolio averages. We're talking that 2.19% dividend yield, a massive 15.24% average dividend growth rate, and an 8.98% average share price appreciation. What is completely mind-blowing about these numbers working together is that the portfolio doesn't just grow in total value over time. It literally continuously gives itself a raise. The cash it plays out to you just keeps going up. Okay, let's take all these impressive averages and apply them to a real-world scenario. And we're going to use a remarkably tiny habit to do it, investing just $5 a day. That's $35 a week. Since we're using 5 funds, you are basically just dropping one single dollar into each fund every single day. Honestly, $5, it's the kind of money most of us blow without even a second thought. So let's watch the compounding magic happen. By year 10 of just sticking to this simple $35 a week routine, your snowball is getting seriously packed. Your portfolio is projected to hit around $32,000. At this point, it's not just about your weekly deposits anymore. Those reinvested dividends are starting to buy significant chunks of new shares all on their own. The momentum is getting very, very real. Fast forward to year 20, and the gap between what you've physically put in versus what you actually have is just wild. Over 2 whole decades, you've only pulled $36,500 out of your own pocket. But thanks to our good friend compounding, the snowball has surged to a massive $160,000. And get this, it's now kicking off nearly $9,000 a year in completely passive dividends. But wait, because the final decade is where this explainer reaches its absolute climax. Over 30 years, putting in just $35 a week means your total out-of-pocket cost is still under $55,000. But the market and the sheer force of compounding have taken that money and multiplied it by 17 times. Your final balance? A staggering $942,000. Let that sink in for a second. It is so incredibly vital to fully grasp this concept. Out of that final near $1 million amount, over $887,000 did not come from your blood, sweat, and tears. It didn't come from your paycheck. It was generated entirely by this system: compounding, reinvested dividends, and decades of steady market growth. Your portfolio essentially became a second version of you, actively doing the heavy lifting while you were just out living your life. And what does a portfolio that size actually do for your day-to-day life? It translates to roughly $98,000 a year in pure passive dividend income. That's about $8,000 landing in your bank account every single month. And the best part? You didn't have to clock in, answer an email, or attend a single meeting to earn it. This completely validates the ultimate financial truth we talked about right at the start. You really don't need a massive 6-figure salary to build incredible wealth. You don't need to be a Wall Street genius, and you definitely don't have to perfectly time the market. You just need to let consistency and compounding do their thing until your investments literally out-earn your day job. So, knowing all this, knowing that a massive, totally life-changing financial snowball can start from almost nothing, we've got to ask ourselves the tough question: what small daily expense are you willing to redirect starting today? Skipping one overpriced coffee or that mediocre fast food run could literally be the $5 a day that completely secures your financial freedom tomorrow. So what's it going to be? Start packing that snowball today. Thanks so much for joining me on this explainer, and keep learning.